Welcome back to another episode at Economics Design. Still in line with stablecoins that we are talking about, today we're going to talk about the OG on-chain stablecoin, MakerDAO. We're going to dive deeper into the economics of Maker, as well as understand a little bit more about how DAI works. Again, quick disclaimer, nothing is investment advice, everything is educational. We're going to cover 5 things today. What is Maker? How is DAI created? How to maintain stability? How to deal with crashes? And some opinions and thoughts. What is Maker? In this context of the video, we're going to focus on the token economics framework, specifically in the token design pillar, which is the third pillar. In the third pillar, we're going to focus on 2 different categories, which are token policy as well as financial incentives. Basically, DAI is an on-chain stablecoin. It's soft pegged to $1. So we want to understand the different kind of policies involved and the different kind of policies related to the token being embedded and programmed into the code of the token, as well as some financial incentives that allows this entire ecosystem to be very robust and to continuously allow the different agents to interact so as to get that $1. So in the previous video, we talked about how the mechanisms of stablecoins, they have changed since 2017. And we're going to start classifying stablecoins into the 4 different categories. In terms of the mechanisms, the peg that it is pegged to, the collateral amount, and also the collateral type. So for Maker's ecosystem, for MakerDAO's ecosystem, DAI, which is the stablecoin, uses dual token and reserve mechanism. It is soft pegged to $1. It uses over collateralization to get that $1. And it uses different kind of on-chain crypto assets like ETH, stablecoins, and non-stable coins. So this is how we use the toolkit that we talked about last time to classify and understand what's going on in different stablecoin mechanisms. So, what is the dual token mechanism? Dual token, as the name suggests, there are 2 tokens in the system. There is the stablecoin, which is DAI. It is soft pegged to $, and there's a secondary token, MKR. This secondary token, the primary goal is for it to absorb volatility in the system itself. So think of it as DAI being your output, which is stable, it has low volatility, but there will always be volatility within your system, outside of your system. And the volatility needs to go somewhere. Where does it go to? It goes to MKR. It goes to the other token called MKR. So what is this function of the MKR token? It is a utility token, and it functions like governance token for voting. It can be used to pay off interest accrued in the system. And during insolvency, so during crashes or different kind of liquidation, it's insolvent, MKR can be minted to be sold for DAI in the ecosystem. So MKR is quite a crucial part in governing the entire system of DAI. DAI is really the facilitator to allow people to exchange for goods and services, and MKR, it plays a governance role in your entire ecosystem. So because MKR plays the governance role of this utility function, a few months ago, when MakerDAO moves more of its funds towards decentralization, towards the DAO, which means it's not mainly controlled by the founders, but it's mainly controlled by the community, then you can imagine that the prices of MKR soared because there is more of this utility function that the MKR token can accrue. So that's just some fundamental values or intrinsic value that the MKR token has. But we're not talking about the MKR today, we're talking about DAI. So what does it mean when it uses the reserve mechanism? It's very simple. It means that the stablecoin, the DAI, it is backed by reserves, and you can use the DAI to redeem for the underlying collateral. That is the idea of reserve mechanism. It can be backed by whatever reserve, but if you can't redeem it for the underlying reserves, it's not really reserve backed, right? Reserve backed means you are able to redeem it for the underlying. So that's key. With DAI, you can redeem it for your underlying. You basically redeem it for the crypto assets that you have deposited to get DAI. What are these different crypto assets? Take a look at Oasis, which is the MakerDAO's system, or one of these MakerDAO systems. We have ETH, we have Wrapped Bitcoin, USDC, we have Paxos Standard, we have Yearn, we have Chainlink, Trust Token, and a lot of LP tokens from Uniswap. So these are different kind of crypto assets that you can deposit to withdraw DAI, to create DAI. What is this DAI thing? How do you create that? How does the whole thing work? Let's take a deeper dive into it. You can create DAI in really just 3 very simple steps. First one is you have to own the assets. Second, you deposit that asset into a vault. Thirdly, based on the amount of value in the vault, you can mint some DAI out. So you can take some DAI out and then you can use that DAI in whatever system. So the only thing that you have to be careful about is the minimum collateralization ratio. If I have $150, $150 worth of ETH, I put it in my vault, in my box, or my security bank, then out of that, I can take out maximum $100 worth of ETH from this vault, and I can spend it somewhere else. And my $150 worth of ETH is just sitting in the vault. It just can't be touched until I repay the amount that I borrowed, which is 100 DAI. So this is the idea. And what are some risks involved? So what happens when your ETH falls in price, falls in value? I put $150 worth in there. I didn't do anything. I didn't touch anything. But somehow prices fell and ETH is now $100. And I borrowed $100 out. So my collateralization ratio is 100%, which is less than the ideal amount. The ideal amount is about 150% in this scenario. So what do I have to do? I will have to either repay the loan, repay the collateral. So instead of borrowing 100, I repay that and I repay like 33 DAI. Or I add 50 more ETH, like $50 worth of ETH into the collateral so that it balances, so that the minimum collateral ratio, C ratio, is balanced. So that's something to note. And if you're from the traditional finance world, or if you are more familiar with capital market, it's basically, mortgage. When you have a car and you go to the bank and tell the bank, I've got this car, can I use that as collateral so that I can borrow some amount of money just for 3 days and I'll return you plus interest. This is the general idea. Of course, that's more short term. The longer term, because cars depreciate in value, but the longer term will be stuff like housing. So you have a house and you mortgage your house to get some loan out and you use that loan in something else and then you repay their mortgage. So that's the similar general idea with what you're doing with Maker. So then one of the key things would be, how do you maintain stability? Because we talked about how there are two tokens, DAI and Maker, MKR. So MKR is the one that allows them to fluctuate and, that's not within our control. That's not one of these mechanisms that we want to embed and want to program into our token. With DAI, it's fixed at $1. So what are the different kind of code that we can program, that we can embed into the stablecoin so that when things fluctuate too much, the code will execute and deal with it quite quickly? The alternative is what we have with fiat money today, where central banks try to manage that, via interest rates, via open market operations to maintain that stability. And then they also have long run plans, trying to understand what's going on in the market and then trying to have different kind of monetary policies to deal with it. While that is good, there's also some problems, which is the monetary policy is quite laggy and the market moves so much faster and sometimes the monetary policy isn't really reflective of what the market conditions are. But with programmable money, like stablecoins, you can program some level of monetary policy into the code. And so you can execute the code according to what the market conditions are. How cool is that? So, what are two scenarios where DAI is not stable? The first one is when it's more than $1, and the second is when it's less than $1. When it's more than $1, there are two ways to deal with it. You have short-term and long-term, just like central bank. In the short term, because it's more than $1, and the system always values it as $1, but the outside system, when people are trading, it's maybe $1.05, but the system always views it as $1. So if I can mint it at $1 and trade it outside at $1.05, I just earn 5 cents from nothing. It's called arbitrage. So what will people do? Simple. People will take their ETH or take their collateral, open one of these vaults that we mentioned, deposit it in, borrow DAI out, and then sell the DAI in the secondary market. This is the whole arbitrage system. And the thing that's effectively being done is to increase the total supply of DAI. And when the value is kept, the total supply increases, the price of each of these tokens fall. So you have a natural limit when people stop doing that, when the secondary market is only trading at $1. From $1.05, to get it back to $1, you need to increase supply. And the system can't just say, let's just print free money and free DAI for everyone. It doesn't work like that. Instead, you have economic agents who are incentivized to want to earn via this arbitrage, and they will borrow or get ETH, mint, DAI, trade in the secondary market, come back and close their vaults. So it increases the total DAI supply. You can think about it that way, and then prices fall back to $1. That's a short-term way because, that happens very fast because there's free money available. In the long run, there are two ways that can be done. The first one is to increase the DAI savings rate. Currently, it's at 0, but in the future, they're looking at creating something like a small amount of fees being generated if you deposit your DAI in the system. Just like a bank. Your fixed interest rates that you earn from the money that you deposit in the bank, you can earn some savings. And this is what they want to do. Right now, it's 0, but in the long run, you can decrease it, so it incentivizes people from removing their liquidity and then increasing the supply in the system. So it's all about increasing supply. The other long-run mechanism is to decrease the stability fee, which is the interest rate. So when you go to a bank and you say that I'm going to mortgage my house, so you can lend me some money, and every month I will repay you some amount of money. That amount of money is the principal, yes, and also some interest, because the bank is giving you additional money upfront and you have to pay for that. It's a service being provided. In the same way, there is this interest rate that's accrued when you're depositing your ETH into the vault and borrowing DAI out. It's an interest rate, they call it the stability fee. So when DAI is more than $1, we want to incentivize the increase of supply. And so we want to decrease the stability fee, so decrease the interest rate so that more people will be borrowing and more people will increase the supply of DAI in the system. So that's how it works when DAI is more than $1. When DAI is less than $1, the exact opposite happens. In the short run, people will use DAI to repay their debt. So people go out to the market, buy DAI, use DAI to repay the debt, close the vault, or just repay the stability fee, and it reduces supply. Supply reduces, prices increase. In the long run, we can increase the DAI savings rate. Right now, again, it's at 0. But when we increase DAI savings rate, they want to put the money in the bank, if you think about it, to be earning that interest or to be earning the savings rate, which reduces the total supply. Or you can increase the stability fee, which is to increase the interest rate, so it makes it more costly for people to be printing or to be creating more DAI. So you want to reduce the demand of DAI that's available out there. So that's what is being done. And what about crashes? What about liquidations? I think this is really, really important because when we think about how stability is maintained, it's not just about how we get stability in the long run and short run of the asset itself, the stablecoin, but it's also important to think about what happens when market crashes because these assets are collateralized by something else. They're backed by reserves. So when the value of the reserves fluctuate, the mechanisms to maintain that stability is quite volatile. So how can we deal with that and how can we manage that kind of volatility? So there are two ways. The first one is an emergency shutdown. So the whole system stops minting DAI and you can basically start closing your vaults because you start repaying the system. And you have a liquidation mechanism. People who can't afford to repay their vaults, then the vault itself will be liquidated and that would be done through auction mechanisms. So they will auction out the vaults. The fees earned from the auction will be used to close and cover that vault and repay the entire system. And that's why right now the system is still quite new and things can still be quite volatile. And that's why you have a high percentage of collateral ratio, which is 150%. You go all the way up to 175%. And that's because any fluctuation in the collateral can greatly affect the stability of the token. So having a higher collateralization ratio reduces the impact in which the volatility of the collateral will affect the stablecoin itself. So, some general opinions. The first one is, how is this different from lending and borrowing? Because at the end of the day, you're basically lending your ETH to get out DAI, and you're lending ETH, you're borrowing DAI, and then you're using DAI in some other system. It is quite similar to lending and borrowing because you're kind of like lending the bank your house mortgage, and then you borrow US dollars out and you use it to buy groceries and live your life. Well, the difference is that the value of the asset that you're borrowing, the stablecoin, is not managed by a secondary party, but by the system itself. So yes, you're lending and borrowing, but you're borrowing a stablecoin asset that's managed by the system, and that allows for more customization, more mechanisms, more incentives being programmed into the entire system. So it allows for more control over how the ecosystem can grow. Lending and borrowing is one of these infrastructure layers, like a building block. And so Maker is taking that building block and adding different kind of building blocks, which is the creation of a currency to be added into the lending and borrowing mechanism. So yes, it functions quite similarly to lending and borrowing, but it's also quite different because in this system, it also has a different kind of asset class, which is the currency created by the system. And that means every incentive that's being done, all the different mechanisms in place, they all have to align, not just the function of it as a lending and borrowing application, but also as a stablecoin to maintain the stability, to reduce risk of volatility, all the kind of stuff that we've talked about. They have to manage both of them. And that's why it's quite different. There's also some arguments or some discussion saying that, okay, why do we need to create stablecoins on-chain? Because you can do that off-chain. Things like Tether, USDC, you have all these stablecoins out there where it's collateralized with fiat money. So you have US dollars in the bank, or you have whatever kind of assets in the bank. And from there, you create the crypto USD or the digital USD, and you can use that within the ecosystem. Yeah, sure, that's possible. But is that good enough? What if we can go a step further? And this step further is by having all assets on-chain, so you have transparency, you can verify the data on-chain, and it allows people to do some risk calculations even to understand what is the total amount that is being capitalized or collateralized in the system and compare it to other kind of asset classes or different kind of protocols. So transparency is actually a very, very big plus, especially when everything is on-chain. You can't fake your data. If everything's off-chain, yes, you can have transparency, but you can still fake your data. Whereas if things are on-chain, no one has control over the data. It's all 100% transparent for everyone to see. So that's one of the benefits of on-chain versus off-chain collateral. And lastly, one thing that happened recently is one of these big crashes of 2021. And we saw a similar crash like that in March of 2020. So a very interesting analysis that you could do is to analyze what is the recovery rate of different kind of protocols that existed last year and this year. Then you can do some measurements to see how has the change in mechanism design affected the rate of recovery of these protocols. And it's good to say that Maker has done a great job in that. Last year, when the crash happened, it was called the Black Thursday, Maker suffered quite a bit because fees were so expensive and liquidations were a little bit inefficient. You have people getting the entire liquidation vault, the auction mechanism that I talked about. So they got a lot of ETH for free. They just have to pay a lot in transaction fees to be voting for that. So there were a lot of problems then. And since they have changed and upgraded their mechanisms, so one of the things is a multi-collateral DAI. Instead of DAI being backed by just one asset, which was ETH then, today they're backed by a lot more other assets. Which is good because, yes, in general, all these crypto assets, they are all quite correlated. Okay, not going to lie, they're all correlated. But that's okay because a lot of these assets in the world, they're correlated. Okay, we can find ways to make it uncorrelated. That's a science on its own. The other thing to think about is the recovery rate of these assets. Sure, when they fall, they are correlated in falling, but the recovery, they have a different kind of rate of recovery. So some assets recover really quickly. Some assets don't recover quite fast. Because when they fall together as the market decreases, it is the macroeconomic activities that causes the market to fall. Everyone falls together. But the reason why it rebounces, the reason why it recovers so fast, is not because of macroeconomic activities, but because of microeconomic activities within the ecosystem itself. So, for example, Yearn fell quite quickly, rose quite quickly, fell again, rose again. And that's because of the strength of the community. They're demanding for the token itself. And the token is adding value to different people, so people are demanding it. So because of that, you have different kind of recovery rates for different kind of tokens. And when your tokens are uncorrelated in that way, where the bounce back rate, the rate of recovery is quite different, that can help the assets quite a bit. So we talked about how DAI is backed by reserves, it's backed by collaterals, and when collaterals fluctuate, the tokens also fluctuate. But when collaterals fluctuate a lot, but they recover quite quickly as well, it definitely helps the stability of DAI. The other thing that they improved was also the liquidation, the auction. I don't think we went to that stage. It was not that bad this May, although, gas fees were so expensive. It's all-time high. Thankfully, a lot of things were managed quite well, and Maker actually did a very good job in making sure that no one is just randomly liquidated or auctioned off for a very unfair price. So that's a good job. And I think we're seeing a lot of growth in the space right now. I still think stablecoins are very important in the space because when people are new to crypto, they're quite afraid of getting started in very volatile assets. Yes, token A might be very good, token B might be less good, token C is super popular, but token ABC are all, fluctuating quite strongly. Whereas if we can get a token that is a little bit less volatile, a little bit more stable, then that's something worth holding on to, or that's something a lot safer to hold on to for new people coming into the space. And yes, you can argue that you can hold on to the USDC, you can hold on to USDT because it's so liquid, or you can hold on to Paxos dollar. You can do that, but all of these are collateralized off-chain, which is going against the ethos of some people who want to be completely on-chain, who really value transparency and really value the liberty as a person, and you don't have to always go back to what fiat is doing. So having all these assets being collateralized on-chain is really value-adding to different kind of people. And I would say that, maybe stablecoins are not going to be for everyone, because some people who are really into risk, who are, risk-loving, they don't find a lot of value in stablecoins because it is too stable and you can make money through arbitrage. When it's $1.05 versus $1, but that trade, you're only making 5 cents. And to some people, they don't want that. They want to be making $50. You're just taking more risk, and that's okay. There are different kind of assets in the space for different kind of people and different mechanisms to achieve different kind of outcomes as well. This is MakerDAO, and this is the stablecoin that we have talked about. So thank you so much for joining me in this session. If you're interested in more stuff like that, check out our textbook. And if you want to have more chats about things like that, check out our Patreon and our Discord. Till then, I'll see you in the next week.